Hello and welcome back. In this video, I want to cover kind of a demo on how to record debt investments that corporations make when they invest in debt of another corporation. Now, I want to look at exercise 16-2. It's on page 714 of your textbook. So, what we have here is Genic Corporation. They had the following transaction pertaining to debt investments, right? They have four. They purchased 59% $1,000 lead company bonds for 50 grand cash. Interest is paid annually on January 1st, 2017. Okay? Super simple, right? So the first thing that we need to do is just do our journal entry, right? Because remember, we only do journal entries when one of three things happen. We acquire a bond, we receive interest, or we sell the bond, okay? So, on January 1st, we need to book debt investment because that's what we're investing in. And the total amount is $50,000. Okay. And we need to credit cash for $50,000. Now, the problem does not give us any information regarding the cost of this transaction, okay? But let's say for a moment that we purchased 59% 1,000 lead company bonds for 50 grand cash. Let's say that our brokerage firm charged us $150 as a fee, right, to make this happen, okay? What's the journal entry now? Well, if you think back to our PowerPoints, they tell us whenever we book a bond, sorry about that, whenever we book a bond, costs includes all expenditures necessary to acquire these investments, such as prices paid plus brokerage fees, right? Commission, if there is any. Now, in this example, there is none. But what if there was? Okay? What if we said that in addition to that cost or that price, our brokerage firm charged us an extra $150? What would the journal be? Okay? It's not your book. This is just a little something I added to the problem for demonstration. If the brokerage firm charged $150 commission. Okay, what's the journal entry look like? Well, in that case, it's going to be identical, right? January 1st, I need to debit debt investment for how much? Well, it should be $50,150. Why? Because they included a cost of this. So I need to include that cost, right? I'm going to credit cash for the same amount, 1,000 or 5,150, okay? So keep in mind, we need to include the cost whenever we're dealing with debt investments, okay? Now, let's go back to the book, and they tell us that accrued interest on Leeds Company bonds on December 31st, 2017. Okay, no problem. That's easy for us to do, right? So the second journal entry that we need to do, and I'm going to make this yellow so we don't get confused, okay? That yellow means we discussed a little bit more, okay? So back to the problem in the book. It says on December 31st, we need to record interest, right? We've earned a year's worth of interest. We didn't get paid yet. We'll get paid on January 1st, 2018. But it's the end of the year, right? For financial reporting purposes, we need to recognize the fact that we earned interest revenue. So what do? Well, since we're not getting paid, but we're entitled to that payment, we need to debit interest receivable for how much? Well, just like we did in Chapter 15, calculating out that, excuse me, calculating out that interest is the same exact way, right? What's the total investment? Well, $50,000, right? That's the face amount of the bonds, right? Face amount of the bonds times the 9% equals $4,500, okay? We need to credit revenue because we earned revenue. What kind of revenue did we earn? Interest revenue. Okay? And we're going to credit it for the same amount. Now, notice the amount that we use to calculate interest. We use the face amount of the bonds, right? We did not use, or we use the face amount, okay? Let's say that, let's go back to the assumption that our brokerage firm charged us the $150 commission, okay? So the total investment that we have in this debt investment is $50,150. If I do the journal entry, or when I do the journal entry to accrue interest, it's going to be the same, okay? Meaning it's going to be the same journal entry. The reason why is we always have to use the face amount, okay? So try not to get confused, or you need to remember when we are calculating interest, it's always the face amount that's on the bonds, right? That company that we bought the bond off doesn't care that our brokerage firm charged us $150 in commission. They don't care at all, right? So we're not going to use the carrying value on the books of $50,150. We're going to use the face amount, okay? Then they tell us on January 3rd or January 1st, 2018, the problem says that we received the interest from Leeds Company on January 1st, 2018. So what's the journal entry? Well, we already accrued the revenue. We just have to show that that receivable, or that interest receivable, has been satisfied and we have the cash now. So what do we need to do? Well, we need to debit cash because we're getting cash for $4,500. We need to credit our interest receivable because we don't owe, or we're not owed that money anymore, right? That this receivable has been satisfied. $4,500. Okay? Now, notice, or the fourth part of the problem says that we sold 30 Leeds Company bonds for $33,000 on January 1st, 2018. Okay? So we need to figure out what our journal entry is for the sell, right? So on January 1, 2018, we're going to recognize that we got cash and we sold off our debt investment, okay? So what's the journal entry? Well, I need to debit cash. I need to credit debt investments. Okay. And then we need to, I'm going to come down here and I'm just going to say question mark, gain or sell, because we need to calculate if there is a gain gain or loss, right? We need to calculate that, okay? So how much cash do we receive? Well, we don't need to calculate anything. The problem tells us we sold the bonds for $33,000. Guess what? That's the cash we received. Okay. Debt, the debt investments. How much did we sell? Well, we sold 30 bonds, right? So how much are 30 bonds? Well, think about that, okay? The face value of those bonds that we have are $50,000. We basically sold 3/5 of them, right? Oh, sorry about that. We sold 3/5 of those. So we're going to multiply the 50,000 times the 3/5, right? That ends up being $30,000. Okay? That's the value of the bonds that we got rid of, 30,000. So we then have a gain, right? So I need to credit my gains. So I'm going to say gain on sale of debt investment is going to be $3,000. Okay? Now, let's say for a moment that in order to do this sell, our brokerage firm charges us $150 commission. Now what do we do? Okay? Well, that's easy. Let's think about it and calculate it out. Okay? First of all, we're receiving cash, right? We need to debit our debt investment. And we already know we have a gain on sale of debt investment, so that's probably going to be the same thing, right? Meaning the fact that they charge us the $150 in commission is not going to impact our gain or loss that drastically. Okay, so there's the journal, or there's the debits and the credits. Now, how much cash are we receiving, right? Here's where that net proceeds comes back, right? Well, I'm getting $33,000 cash for selling those bonds, just like the problem said. But let's say that on top of that, our brokerage firm charged us the $150. We need to subtract $150. Our net proceeds now, sorry about that. There we go. Our net proceeds now are $32,850. How much debt investment did we sell? Well, that's going to be the same, right? We have $50,000 of face bonds. We're still selling 3/5 of those. So I need to multiply that by 3/5. I still end up with 30,000 decrease in my debt investment. Okay? Now you might be saying, well, wait a minute, why didn't we use the 150? Again, we're not worried about that $150 that was charged to us as commission for buying. We just include that as part of the debt investment, as opposed to saying, oh, we have an investment investment expense, right? We don't use investment expense. We just put it in as part of the debt. Okay, part of the debt investment. The debt investment. Well, what we sold was $50,000 face amount, right? The fact that we paid $150 for those before, or $150 commission on those, that other person doesn't care, right? So, what's our gain and loss now? Well, we just subtract, right? Net proceeds from the debt. We get $2,850, okay? So I just wanted to include the example of what we do, how do we get those net proceeds, right, when we sell something. And that's how we do it, okay? So tune back in for our next video where we go ahead and cover stock investments.